Hello and welcome to this first summary video in financial reporting and analysis. As you are aware that FRA consists of 20% of the exam, that is 24 questions will be coming from the FRA section in both the AM and the PM session. Before moving into the nitty-gritties and key aspects, I would just like to give you an overview about the FRA curriculum, why it is there in the CFA program and how you should handle the same. This introduction, is very useful, or in fact this FRA, the readings that we will be discussing today, are really useful for someone who does not have any prior experience, prior interaction in the accounts field. While the income statement or the financial statement, which consists of the income statement, the balance sheet, the cash flow statement, the notes to accounts, all these topics are discussed in detail in the next study session or in different readings. Students must pay extra attention to other sources of information for the purpose of financial analysis. FRA in the CFA program is to be used as a tool in equity valuation. When we want to value a particular company, as in value the stock of a particular company, we need to know about the economy in which the company operates, or rather economy in which the industry in which the company operates, the industry on a standalone basis, and then the company. This is known as the top-down analysis or the top-down approach. If I'm a global fund manager, and I want to decide where I need to invest my client's corpus, the first step I need to see is a particular where should I invest it, whether it should be in India, whether it should be in Brazil, whether it should be in developed nations, or whether it should be in developing nations. That is the call that I need to take. Calculation of ratios, common size statements, and all those tools are simple, and in the long run, as a CFA charter holder 5 years, 10 years down the line, you would be required to give your inputs in terms of more analytical issues. You, as the CFO of a particular company, will be there in terms of handling the different aspects and different inputs into the equity valuation process, or into where you need to invest the company's money. Whether it should be developed nations or developing nations, that would be your call. That would be your understanding. The nature of the audit report is also important. Every financial statement needs to be verified. Not every financial statements as a whole, in which each financial statement is verified. Because as you may know, financial statements are linked. Each entry is based on the double accounting principle, double entry system, double accounting entry principle. So therefore, the impact of an item on the income statement has to be seen on the balance sheet, and also has to be seen whether a particular item, has any impact on the cash flow statement. The numbers needs to be verified thoroughly with the help of the notes to accounts, and this is the work of an auditor. In India, this work is carried out by chartered accountants under the umbrella of Institute of Chartered Accountants of India. Also, the footnotes to financial statements, the proxy statements, the management's discussion and analysis, and supplementary schedules are really useful in terms of enumerating the steps in the financial statement analysis, and it is really important from an understanding as well as an exam perspective. Financial reporting refers to the way the companies show the financial performance to investors, creditors, and other interested parties by preparing and presenting the financial statements. The main purpose of financial statement reporting is to provide information about a company's financial performance, financial position, and changes in financial position. That is, income statement, balance sheet, and the cash flow statement. On the other hand, the role of financial statement analysis is to use those financial statements along with other relevant information in order to make economic decisions. Such decisions may be whether or not I should invest in a company, whether or not I should grant loans to the company as a bank, whether or not I should lend goods on credit to the company, and if I have to, then at what terms. It involves assessing the past performance in order to evaluate or forecast the future of a company with the help of those financial statements and other relevant information. Assessments are performed prior to making an investing decision, offering any credit facilities, and making economic decisions related to the company. Equity analysts, as well as other analysts, but mainly equity analysts, use the financial statements to evaluate the current and the past financial position in order to form opinions about the ability and the capability of the company in order to generate shareholders' wealth in the future. A company's performance can be examined via profitability and cash flow measures. These are really important in forecasting. A forecast of the expected amount of future cash flows is important in determining the ability of a company to meet its obligations. Management also performs financial analysis in everyday decision-making process. However, management may rely on internal financial information that is likely maintained in a different format and unavailable to external users of financial statements. Liquidity refers to a company's ability to meet its short-term obligations. On the other hand, solvency refers to a company or a firm's ability to meet its long-term obligations, and this understanding needs to be thorough. If I need to say whether the company will be able to meet the payment of its creditors, whether or not the company will be able to meet its interest expenses in the coming fiscal, all that has to be assessed with the help of liquidity measures, liquidity ratio measures. On the other hand, whether the company is going to sustain, whether or not the company is going to stay in the business, whether or not the company will be able to generate shareholders' wealth, whether or not the company is going to destroy shareholders' wealth, all those things will be understood with the help of the solvency measures. We now move on to the statement of comprehensive income. The statement of comprehensive income or the income statement is also known as the statement of profit and loss. It is known as a statement of financial performance because it provides operating information relating to a company's business activities over a particular time period. In the income statement, on a simplistic note, we have incomes and expenses. And the difference between the income and the expenses would be termed as the net income. It is the income available to the equity shareholders or the owners of the company. It can either be in the form of retained earnings, which is then plowed back into the company by the management for the purposes of growth, or it may also be distributed as dividends. All this call, okay, whether what percentage of net income is to be given as dividend, what is to be kept as retained earnings, okay, because at the end, retained earnings, if there is higher retained earnings, it increases the market cap of the company. When it increases the market cap, it is happening at a capital appreciation of the shares that an investor holds. So either you get dividend or you enjoy capital appreciation. However, there are nitty-gritties involved in all this. What are those nitty-gritties? Whether dividends are taxed at a higher rate or whether capital gains are taxed at a higher rate. All this understanding needs to be done. And then you need to invest your client's corpus into a particular stock. Balance sheet. Balance sheet, which is also known as the statement of financial position, presents a company's assets, liabilities, and equity at a point in time. The interrelationship between these three components of the balance sheet is presented in the basic accounting equation as follows: assets equals to liabilities plus owner's equity. Coming to the third financial statement or cash flow statement. A cash flow statement, as the name shows, as the name suggests, shows all the cash expenses or all the cash items or all the cash transactions that happen in a company at a particular time period or in a particular financial year. It reports the sources of receipts and cash payments. The statement classifies the sources and uses of cash into operating, investing, and financing activities. There are three bifurcations of the cash flow statement. The operating activities, which refers to the operations, the day-to-day business activities of a company. The investing activities, which relate to acquisition and disposal of long-term assets. And then we have financing activities, which refers to the procurement and deployment of funds. It all not really deployment, but actually the repayment of funds. Okay, for example, if I have issued bonds, okay, then there would be a cash inflow, but 5 years down the line, okay, I need to repay those bonds again. Both these activities will come under the purview of financing activities under cash flow statement. We then have statement of changes in owner's equity. The statement of changes in owner's equity reports any changes in owner's investment in the business. It is useful in understanding changes in the financial position of a company. Financial notes and supplementary information. Financial notes are an important part of financial statements because they provide detailed explanatory information about a couple of things. Number 1, accounting policies, methods, and estimates. Whether the company is using SLM or WDV, what is the method with respect to recognition of inventory, what are the estimates with respect to useful life, salvage value of machinery, of property, plant, and equipment. Okay, all these come here. With respect to business acquisitions and disposals, with respect to commitments and contingencies, whether the company is a guarantor for a loan for another company, whether if the company fails, I will have to pay that amount as a guarantor. So there is some contingency involved in the payment. All that needs to be seen. The legal proceedings, the subsequent events, the related party transactions. Okay, if a director is involved in the transaction of the company with his own company, he will obviously be doing at an undue advantage and at an undue price, causing a decline in shareholders' wealth. A higher expense means a lower net income, means a lower market cap, and means destruction of shareholders' wealth. So all that needs to be seen. Business and geographic segments and financial instruments and risks arising from them. For example, if a company is involved in global transactions, therefore it has an important risk, that is the currency risk. So whether or not it is using derivatives, and if it is using derivatives, what are the risks arising from derivatives? If it is involved in a swap, okay, an equity swap or a total return swap, what happens if his payment is negative? That means he has to pay and also pay as a fixed obligation, which he was obligated, and he also has to pay because there was a negative return on his leg of the swap. So the risks and the characteristics of the different financial instruments needs to be seen from a company perspective. We then have management's discussion and analysis. The management discussion and analysis highlights about the economy, what the management feels about the economy going ahead, about the industry in which the company operates, as well as its competitors, peers, and where the company sees itself in the next couple of years or in the next years. The management discussion and analysis section highlights important trends and events that affect a company's liquidity, capital resources, and operations. This section must also discuss critical accounting policies, which I just discussed: WDV, SLM, FIFO, LIFO, okay, a cost on NRV, okay, useful life assumption, and all that. All that information that require management to make subjective judgments and that have a material impact on the financial statements. Higher depreciation means lower net income. Lower depreciation means higher net income. So the management can play around with the help of these estimates, with the help of these accounting policies, in order to have their own agenda fulfilled. At the higher end of the spectrum, the management salary is contingent based. It is based on the assumptions, it is based on the principles of actually variable pay. So higher net income means they are getting a higher proportion. Therefore, they would want to inflate the net income, the revenues. Okay, they would actually do different earnings management techniques such as bill and hold policy, okay, channel shuffling. All that can be done in order to increase the net income, inflate the net income so that they can earn a higher return. From an understanding and an analytical perspective, all these five financial statements that I have discussed are really important, not just for the exam, but you understand these from the perspective of an analyst. I have tried to give real life statements. I have tried to give you real life examples so that you can relate to them better. And maybe after level 1, okay, when you were employed as a junior fixed income or a junior equity research analyst, okay, you are able to use all this information, all this knowledge that you've built up in order for the purpose of real time analysis. What exactly happens in the CFA program is this. I cannot comment or in fact I would not comment about the curriculum of different subjects, but CFA curriculum is really supreme. It really maps real life and what exactly is needed by a person in order to excel in real life. In BCom BBA also a subject of financial statement analysis is there. Okay, and there that subject is really disrespected. We are just supposed, or we are just meant to calculate ratios and all, okay, and we are not supposed to do interpretation and all these analytical aspects. And therefore I just love this FRA portion in the CFA program. It just brings out the best of the aspects, the best of analytical skills, the best of judgments required. Out of 13 readings in the FRA curriculum, okay, 6 readings are analytical based, and in those 7 readings, again, almost 40% of those readings are analytical based. So therefore, out of 13 readings, 9 to 10 readings, okay, or in fact I would say around 70 or 60-70% of the LOS requirements, okay, are based on analytical aspects. You can easily Google and find out the calculation of cash flow statement from the direct or the indirect method. Okay, but how would you interpret a cash flow statement? How would you read the management's discussion and analysis? What are the things that needs to be taken care of? All those things really need to be taken care of, understood, and then applied going ahead. We now move on to audit opinions. What exactly do you mean by audit opinion? The financial statement that the management prepares needs to be verified by a third party. In India, that third party is a chartered accountancy firm or a chartered accountant. Now, what will exactly be the role of this chartered accountant or auditor? The role of this person would actually be to go and gauge through the financial statements and see whether there are any material misstatements or not. And on the basis of that analysis, understanding of those financial statements, the auditor will give his audit opinion. And the audit opinions are as follows. Number 1, an unqualified opinion. It means that the financial statements that have been prepared by the management have been fairly prepared, and they represent, okay, all the information needed for the users of financial statements, and the financial statements have been prepared in accordance with the applicable accounting standards. A qualified opinion states that the financial statements have been fairly presented but do contain exceptions to the accounting standards. It means that the management has played around with those accounting standards, and therefore it gives a smell of something that is not right about a particular company. As an equity research analyst, I need to factor all this into my analysis. Now, the text says that we cannot give you numbers, that if there is a qualified opinion, take a cost of equity of 4%, 1% higher, okay, or take a cost of equity of 0.75% higher. That is not given. But all this understanding is actually important, is actually critical for you in terms of understanding how things move ahead. An adverse opinion. An adverse opinion states that the financial statements have not been presented fairly and significantly deviate from acceptable accounting standards. Therefore, it is actually a bad thing, and as an equity research analyst, I should never invest my client's corpus into a company in which the auditor, the chartered accountant, has given an adverse opinion on the financial statements. A disclaimer of opinion is the extreme case and issued by the auditor when he is not at all be able to form an opinion on the financial statements. That means he is actually confused about the management's preparation of the financial statements. We now move on to the basic accounting equation. We already saw that the basic accounting equation says that assets equals to liabilities plus owner's equity. We can rearrange the equation as follows, where owner's equity is contributed capital plus ending retained earnings. And ending retained earnings is beginning retained earnings plus net income minus dividends declared. Therefore, we can have assets equals to liabilities plus contributed capital plus ending retained earnings. On further expanding, we get the following equation. From an exam perspective, you need to know not just the basic accounting equation of assets equal to liabilities plus owner's equity, but you need to know its expanded form. A data might be given and you need to actually find out the answer. Until and unless you know the formula, okay, you will not be able to find out what is asked by the question. In our class videos, we looked at different examples, okay, in which we discussed about the use of these accounting equations, both the basic and the expanded form in terms of calculating. For those questions, please visit my class lectures. We now move on to the different components of the financial statements. Coming to balance sheet, the first main components are assets. Assets are economic resources that help the company to earn. And assets may be classified as current and non-current assets. Current assets are those, okay, which are expected to provide short-term benefit to the company, while non-current assets are those which are expected to provide long-term benefits to the company. Current assets include cash and cash equivalents, accounts receivable, trade receivables, prepaid expenses, inventory, non-current among others. And non-current assets include property, plant and equipment, investment property, intangible assets, among others. You can clearly see that non-current assets are used to generate cash flow for the company. And for example, there is a particular plant or a particular building or a particular infrastructure. Will that only provide benefit to one accounting cycle or 1 year or a very short time period? No, that is expected to generate or manufacture materials, generate cash flows for a very long time period, and therefore they are non-current asset. Look at the nomenclature, current asset. It is for the current benefit, and something that is not for the current benefit, for long-term benefit, it is known as the non-current assets. Liabilities, on the other hand, are claim on economic resources such as assets. Liabilities include accounts payable, financial liabilities, deferred tax liability, long-term debt, and unearned revenue. Similarly, they can also be classified as current and non-current liabilities. We then have owner's equity, which are actually claimed on the residual company resources and include capital, retained earnings, and other comprehensive income. Now, coming to the statement of comprehensive income or the income statement or the statement of profit and loss, the two items are revenues. Revenues are actually flow of resources in a company, and expenses are flow of economic resources out of the company. These include the different items. We now move on to something known as accruals. There are two accounting techniques. One is an accrual based accounting and the other is a cash based accounting. Here we've discussed accrual based accounting. The deeper analysis of each of these accruals are there on my class lectures. I would want you to visit them for understanding. However, I have presented a summary of the accrual slide on this video so that you have a more holistic perspective in terms of completeness via these videos. Pause the video, read these accrual, the 4 types of accruals: unearned revenue, prepaid expenses, unbilled revenue or accrued revenue, and accrued expenses. What exactly are they? Okay, what are the accounting effects? Okay, and so on and so forth. Pause the video, be on top of this slide, and then move ahead. The desirable attributes of an accounting standard board include properly defined. All the parties involved should observe high professional and ethical standards. The organization must have adequate authority, resources, and competencies. A well-articulated framework with a clearly stated objective to guide the board. The board should not succumb to external pressure from external forces. And the final decision must be in terms of public interest and must lead to high quality of standards that would be recognized and adopted by regulatory authorities across the globe. The 2 main accounting standard boards are IASB, which propagates the IFRS, and FASB, which propagates the US GAAP. The required financial statements I've already discussed, include the statement of financial position or balance sheet, the income statement, statement of changes in owner's equity, the cash flow statement, the notes to accounts, management's discussion and analysis, and in some cases, comparative statement of financial position. This slide shows the structure and content requirements, as laid down by the different accounting standards boards. I've picked this out from the curriculum, and what they are trying to say is that how exactly should financial statements be prepared. For example, the balance sheet must be prepared as current and non-current assets and liabilities. There must be some minimum information on the face of the financial statements. Minimum information must be in the notes for the purpose of analysis. Comparative information for prior periods must be stated unless a specific standard permits otherwise. Accounting policies, SLM, WDV, cost, NRV, FIFO, LIFO, weighted average, all those things, accounting policies, estimates, useful life, all those things needs to be properly disclosed. From an understanding, analytical, and an exam perspective, I would want you to be on top of this slide. We now move on to the qualitative characteristics. The 2 fundamental characteristics that make financial statements useful are relevance and faithful representation. The financial statements must be relevant in order to make economic decisions, and they must faithfully represent all the information, all the transactions that has happened in a particular company. To enhance relevance and faithful representation, 4 characteristics are comparability. The financial statements must be compared on a time series basis and also on an interfirm basis. Verifiability, that is, an auditor must be appointed in order to verify the financial statements. An auditor is a third party. The financial statements must be presented in a timely manner and they must be understandable to the general public who has basic understanding of accounts and the markets. The required reporting elements includes assets, liabilities, equity, incomes, and expenses. We've already discussed the same in a previous slide. The constraints and assumptions according to the conceptual framework, is that there is a cost-benefit trade-off of enhancing characteristics. Another constraint not specifically mentioned in the conceptual framework is that non-quantifiable information about a company cannot be captured directly in the financial statements. The general features of financial statements include fair representation, going concern, consistency, accrual basis, materiality, aggregation, no offsetting, frequency, and comparative information. The characteristics of an effective financial reporting framework include transparency. The financial statements prepared must be transparent to the investor and the stakeholder community. They must be comprehensive in order to help investors or other people to take economic decisions, and they must be consistent. I used WDV this year, I used SLM next year, I used production units method the next year. Okay, is that being consistent? It is the management playing around, and that is not acceptable, and that is not only permitted by the law but also by the standard. Okay, so all those things need to be taken care of. The barriers to creating a single coherent framework globally include valuation. These metrics, the valuation metrics, differ from geography to geography and company to company. The standard setting approach of different bodies are different. For example, US GAAP is rule based. On the other hand, IFRS is objective based. Okay, so these needs to be taken care of. And then we have measurement biases as well. Now let's move on to a couple of questions. I would want you to pause the video, try the question, and then hear my solution. The second statement actually describes and accurately describes the role of an auditor rather than role of an analyst. The other responses describe the role of financial statement analysis, and therefore option B is the most correct option. This question is actually really simple. I do not think that such a question will turn up on the exam, but just for the purpose of completeness, I've put it. So the statement of financial position is the balance sheet. The statement of financial performance is the income statement. Therefore, option A is the most correct option. Pause the video, try the question, and then move ahead. So the important financial statements include income statement, balance sheet, cash flow statement, management's discussion and analysis, and notes to the financial statements. The notes to the financial statements include the estimates, the assumption, and the methods that the management has chosen in terms of reporting. All that information is actually contained in the notes to financial statements. Therefore, option B is the most correct option. I said that there are 4 types of audit opinions: an unqualified opinion, a qualified opinion, an adverse opinion, and a disclaimer of opinion. An unqualified is perfect. Okay. On the other hand, a qualified opinion is one where the management has made certain exceptions to the accounting standards, accounting policies. Okay. Therefore, option C is the most correct option. Pause the video, try the question, and then move ahead. Business activities may be classified on the basis of the elements of the cash flow statement: the operating, the investing, and the financing activities. Therefore, option B is the most correct option. The accounting equation is least accurately stated as. Do note that the accounting equation, okay, always starts with assets, okay, and the basic accounting equation is owner's liabilities minus owner's equity is assets. Therefore, assets equal to owner's equity equals to assets minus liabilities. Therefore, option A is the most least accurate option. A decrease in asset would least likely be consistent with. With the help of this accounting equation, try to answer this question. A decrease in one side of the equation has to be offsetted by decrease in other side of the equation, or increase in the same side of the equation. Therefore, least consistent would be decrease in one side and an increase in one side. Therefore, option C is the most correct option. If a firm raises $10 million by issuing new common stock, which of its financial statements would reflect the transaction? The financial statements reflecting the transaction, okay, the 10 million raised appears on the cash flow statement as an inflow under financing activities, and on the statement of owner's equity as an increase in the contributed capital. Both assets and equity increase on the balance sheet. The income statement is unaffected by this issuance. Therefore, option C is the most correct option. Pause the video, try the question. Standard setting bodies are private sector bodies that establish financial reporting standards. Enforcement is the responsibility of the regulatory authorities such as SEC, SEBI. Therefore, option A is the most correct option. Which of the following organization is least likely involved with enforcing compliance with financial reporting standards? The IASB and the FASB, okay? They are private sector organization for making these standards, but enforcing compliance is with the help of regulatory authorities such as financial conduct authorities, the SEC, the SEBI, all those. Therefore, option C is the most correct option. The IASB is a standard setting body. SEC is the regulatory authority for US, and Financial Conduct Authority is the regulatory body for UK. In India, it's SEBI. This is a simple question, just directly picked up from the portion that we discussed today. The fundamental qualitative characteristics are relevance and faithful representation. And after relevance and faithful representation, the characteristics that enhance relevance and faithful representation were comparability, verifiability, timeliness, and understanding. Pause the video, try the question, and then move ahead. Financial statements must be prepared at least annually. Fair representation is one of the main important characteristics of the accounting standards principle for preparing financial statements. The ban against offsetting is one of the IAS number 1 principles for presenting financial statements. Therefore, option B is the most correct option. It's least likely. Our last question. Pause the video, try the question. The FASB, which propagates US GAAP, lists revenues, expenses, gains, losses, and comprehensive income. The IASB, on the other hand, only lists incomes and expenses. Therefore, option C is the most correct option. This is all for this video. Thank you.